Listen, something extraordinary is happening in the gold market right now, and if you're holding gold or thinking about it, you need to understand what's unfolding before you make your next move. Because what I'm about to show you isn't speculation. It's not theory. It's happening right now, in real time, and the implications are staggering. Let me start with a question that should make you uncomfortable. Why are central banks around the world buying gold at the fastest pace we've seen in over half a century, while simultaneously telling the public that everything is fine? Why the disconnect between what they're saying and what they're doing? In the third quarter of this year alone, central banks added 337 tons of gold to their reserves. That's not a typo. 337 tons in just 3 months. To put that in perspective, that's more than the entire annual production of most gold-producing nations. The People's Bank of China has been on an absolute buying spree, adding to their reserves for 17 consecutive months. Poland just announced they're accelerating their gold purchases. Turkey, India, Singapore, they're all loading up. And here's what should really get your attention. They're doing this while gold is already near all-time highs. Think about that for a moment. These are the most sophisticated financial institutions on the planet. They have access to information and analysis that you and I will never see. They employ armies of economists and strategists. And they're buying gold aggressively at these elevated prices. What do they know that they're not telling us? I spent the last 3 weeks digging into this, talking to traders, analyzing positioning data, studying the mechanics of what's actually happening in the physical gold market. And what I found is deeply concerning if you don't understand it, but potentially life-changing if you do. Here's the reality. We're watching the early stages of a fundamental restructuring of the global monetary system, and gold is at the absolute center of it. This isn't about inflation. It's not about interest rates. Those are symptoms. What's happening is far more profound, and it's accelerating faster than most people realize. Let me take you back to a moment in history that most people have forgotten, but that's eerily similar to what we're seeing today. It was August 1971. President Nixon walked into the Oval Office on a Sunday evening and made an announcement that would change the world forever. He was closing the gold window. No longer would foreign governments be able to exchange their dollars for gold at the fixed rate of $35 per ounce. The Bretton Woods system, which had governed international finance since World War II, was dead. At the time, most Americans didn't understand what had happened. The stock market actually went up the next day. People thought it was a technical adjustment, a temporary measure. But a small group of investors who understood the implications started buying gold immediately, and over the next 9 years, gold went from $35 to $850 an ounce. That's a 2,400% return. But here's what's fascinating. It wasn't a straight lineup. There were periods where gold consolidated, where it pulled back, where the mainstream media declared the gold rally over. In 1974, gold dropped from $200 back to $120. The headlines screamed that gold was finished. But the smart money, the people who understood what was really happening, they used those pullbacks to accumulate more, because they understood that the fundamental driver, the debasement of the currency, the loss of confidence in the dollar-based system, that wasn't going away. Now fast forward to today. We're seeing something remarkably similar but on a much larger scale. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working to create an alternative to the dollar-dominated financial system. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. And at the center of all of this is gold. China and Russia have been accumulating gold for years, but the pace has accelerated dramatically. Russia now holds over 2,300 tons of gold in its reserves. China's official holdings are listed at over 2,000 tons, but most analysts believe the real number is significantly higher. Why? Because China has been importing massive amounts of gold through Hong Kong and Shanghai, and those purchases don't show up in the official reserve numbers until China decides to report them. Here's a story that illustrates what's really happening. In 2018, I spoke with a trader who works in the London gold market. He told me about a day when a major Asian central bank, he wouldn't say which one, came in and bought 50 tons of physical gold in a single transaction. 50 tons. That's over $1.6 billion worth of gold at today's prices. And here's the kicker. They wanted it delivered. Not paper gold, not a gold ETF. Physical bars, loaded onto planes and flown to their vaults. The scramble to find that much physical gold, to actually deliver it, caused chaos in the London market for weeks. Because here's what most people don't understand. The gold market is massively leveraged. For every ounce of physical gold that actually exists in vaults, there are claims on perhaps 100 ounces in the paper market. It's a fractional reserve system, just like banking, and it works fine until someone actually wants to take delivery. This is where things get really interesting. Look at what's happening in the COMEX gold futures market right now. The amount of gold standing for delivery, meaning people who are actually taking physical possession rather than just rolling their contracts forward, it's at levels we haven't seen in years. In a normal month, maybe 5 to 10% of contracts result in actual delivery. Right now, we're seeing numbers closer to 30% in some contract months. What does that tell you? It tells you that sophisticated players are using the futures market not to speculate on price, but to actually acquire physical metal. They're exploiting the fact that COMEX gold is still priced lower than what it would cost to buy large quantities in the physical market. They're essentially doing an arbitrage, but more importantly, they're draining physical gold out of the system. Now let me show you something that should make the hair on the back of your neck stand up. The COMEX has about 25 million ounces of gold in its registered vaults, gold that's actually available for delivery. Sounds like a lot, right? But there are currently open interest contracts representing over 50 million ounces. That's a 2-to-1 ratio. If even half of those contract holders decided they wanted physical delivery, the COMEX couldn't fulfill those obligations. They'd have to either default or force cash settlement. And here's where it gets even more interesting. The big commercial banks, the ones who are short massive amounts of gold futures, they're starting to reduce their positions. JP Morgan, which has historically been one of the largest shorts in the gold market, has been steadily cutting its short position over the past year. At the same time, their vault in New York has been accumulating physical gold. They're doing exactly what you'd expect a smart player to do if they knew a squeeze was coming. Get out of the short side and accumulate the physical. Let me paint you a picture of what a real gold squeeze looks like, because we've seen it before. In January 1980, gold hit $850 an ounce. But here's what most people don't know. In the weeks leading up to that peak, you couldn't actually buy physical gold at anywhere near the spot price. Dealers were charging premiums of 20, 30, even 50% over the quoted price. Why? Because there was a panic bid for physical metal, and supply had completely dried up. I talked to a coin dealer who was in business back then. He told me stories about people lining up outside his shop before dawn, desperate to buy whatever gold he had. He said he could have sold the same 1-ounce Krugerrand 10 times over. The phone rang constantly. People were offering to pay premiums just to get on a waiting list. And this was before the internet, before global markets were as interconnected as they are today. Now imagine that scenario playing out in today's world, where information travels instantly, where billions of dollars can move with a keystroke, where you have not just individual investors, but sovereign nations competing for physical metal. The potential for a squeeze that makes 1980 look tame is very real. But here's what you need to understand. A squeeze isn't the main story. The squeeze, if it happens, will be a symptom of something much bigger. What we're really watching is a loss of confidence in the fiat currency system itself. And that's not something that happens overnight. It's a process, and we're in the middle of it. Look at what's happening with the dollar. Yes, it's been strong relative to other currencies, but that's like being the tallest midget in the circus. The dollar is strong because the euro is weak, because the yen is weak, because every major currency is being debased simultaneously. It's a race to the bottom, and the dollar is just losing more slowly than the others. But here's the thing. The rest of the world is tired of playing this game. They're tired of holding dollars that lose purchasing power every year. They're tired of being subject to U.S. sanctions and financial surveillance. They're tired of funding America's deficits by buying treasury bonds that yield less than inflation. And so they're looking for alternatives. Gold is the obvious choice. It's been money for 5,000 years. It has no counterparty risk. No government can print more of it. It's universally recognized and accepted. And most importantly, it's no one else's liability. When you hold gold, you're not dependent on any government or institution making good on a promise. Now, I want to take a quick aside here because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, you need to understand that you have options beyond just stocks and bonds. I put together a comprehensive guide on how gold IRAs actually work, how you can get physical gold into your retirement account without triggering tax penalties, how the custody works, what the fees really are. It's completely free, and you'll find the link in the description below. If you're thinking about gold as part of your retirement strategy, it's worth checking out. No pressure, just information. All right, back to what's happening in the market right now. Because there's another piece of this puzzle that most people are completely missing. and it has to do with mining supply. Gold production peaked in 2018 at about 3,300 tons per year. Since then, it's been essentially flat to slightly declining. And here's why that matters. It takes 7 to 10 years to bring a new gold mine into production. You have to find the deposit, which is increasingly difficult because all the easy gold has already been found. You have to get permits, which in most jurisdictions now takes years and faces intense environmental opposition. You have to raise capital, build infrastructure, and actually start mining. What this means is that even if gold prices stay elevated, even if they go significantly higher, we're not going to see a meaningful supply response for years. The gold that will be mined in 2030 is being developed right now, and there simply aren't enough new projects in the pipeline to significantly increase supply. Meanwhile, demand is accelerating. We've talked about central banks, but there's also jewelry demand, particularly from India and China, which remains strong. There's industrial demand because gold is used in electronics and other applications. And there's investment demand, which has been growing as more people wake up to what's happening in the monetary system. This supply-demand imbalance is fundamental and structural. It's not going away. And it's one of the key reasons why the smart money is accumulating gold even at these prices. Now let me show you something in the technical picture that's really interesting. Gold recently broke out above its 2011 high of $1,900. That was a level that had capped the market for over a decade. When you break through a resistance level that significant, especially after such a long period of consolidation, it typically signals the beginning of a major new trend. But here's what's even more interesting. Gold made that breakout on relatively low volume and with relatively little fanfare. There was no euphoria, no magazine covers proclaiming the return of gold, no lines outside coin shops. The general public is barely paying attention. And that tells you we're still early in this move. Think about what happens in a typical bull market. You have the early stage, where the smart money accumulates while everyone else is skeptical. Then you have the middle stage, where the trend becomes obvious and more investors start participating. And finally, you have the blow-off stage, where everyone piles in, where your barber and your taxi driver are giving you gold tips, where the media can't stop talking about it. We're still in stage 1, maybe early stage 2. The blow-off, if it comes, is still years away, and that means there's still significant upside potential for people who position themselves now. But here's what you need to understand. This isn't about trying to time the perfect entry. It's not about waiting for a pullback to some specific level, because the risk of waiting, of being too clever, is that you miss the move entirely. Remember, central banks aren't waiting for pullbacks. They're buying consistently, methodically, because they understand that the long-term trajectory is up, and the risk of not having enough gold is greater than the risk of paying a bit more. Let me tell you about a conversation I had with a portfolio manager who runs a multi-billion-dollar fund. This is someone who's been in the markets for 30 years, who's seen multiple cycles, who's managed money through the dot-com crash, the financial crisis, the COVID panic. I asked him what percentage of his portfolio he had in gold. He said 15%. I was surprised. That's a significant allocation for a traditional portfolio manager. So I asked him why. He said something I'll never forget. I don't own gold because I think it's going up. I own gold because I think everything else is going down. He explained that he sees gold not as an investment, but as insurance against the debasement of financial assets. He said that in a world where governments are running unprecedented deficits, where central banks are trapped in a cycle of money printing, where debt levels are unsustainable, gold is the only asset that doesn't depend on someone else's promise. That's a profound insight, because most people think about gold as just another investment, something you buy hoping it goes up so you can sell it for a profit. But the sophisticated players, they think about gold differently. They think about it as a form of savings that can't be debased, as a hedge against systemic risk, as a way to preserve purchasing power across generations. And here's the thing. If you think about gold that way, then the current price becomes almost irrelevant, because you're not trying to trade it. You're not trying to flip it for a quick profit. You're holding it as a core position, as a foundation of your wealth, as something you might pass on to your children. Now, I want to address something that I know some of you are thinking. But gold doesn't pay interest. It doesn't generate cash flow. How can it be a good investment? And that's a fair question, but it's based on a flawed premise. The premise is that you need yield to build wealth. But here's the reality. In a world where real interest rates, meaning interest rates minus inflation, are negative, yield is an illusion. If your bond pays you 3% but inflation is running at 5%, you're losing 2% per year in purchasing power. You're getting poorer, not richer. Gold doesn't pay interest, but it also doesn't have counterparty risk. It doesn't depend on a government or corporation making good on its obligations. It can't be debased or inflated away. And historically, over long periods of time, gold has maintained its purchasing power remarkably well. Here's a statistic that illustrates this. In 1920, an ounce of gold could buy you a nice men's suit. Today, an ounce of gold can still buy you a nice men's suit. The purchasing power has remained essentially constant over a century. Can you say the same about the dollar? In 1920, you could buy that same suit for about $20. Today, it costs $500 or more. The dollar has lost over 95% of its purchasing power. Gold hasn't. That's the real function of gold. It's not about getting rich. It's about not getting poor. It's about preserving what you have in a world where everything else is being systematically devalued. Now, let's talk about what could go wrong, because I don't want to paint an unrealistically rosy picture. There are risks to holding gold, and you need to understand them. The biggest risk is that governments could try to confiscate or heavily tax gold, as they did in 1933 when FDR ordered Americans to turn in their gold. Could that happen again? It's possible, though I think it's unlikely in the same form. Today, gold ownership is global and decentralized. There are gold ETFs, gold held in foreign vaults, gold in private hands around the world. It would be much harder to confiscate than it was in 1933. But governments could certainly make gold ownership more difficult or expensive through taxation or regulation. That's a risk you have to consider. Though I'd argue that if we reach a point where governments are trying to confiscate gold, that's probably a sign that gold was exactly the right thing to own. Another risk is that we could see a deflationary collapse, where the value of cash increases and everything else, including gold, falls in price. This happened briefly in 2008, when gold dropped from over $1,000 to $700 as investors scrambled for liquidity. But notice what happened next. Gold recovered quickly and went on to make new highs, because the response to that deflationary scare was massive money printing, which is exactly what gold protects against. The third risk is simply opportunity cost. If you put money into gold and stocks go up 50%, you've missed that gain. That's real, but again it comes back to how you think about gold. If you view it as insurance rather than speculation, then opportunity cost is the price you pay for protection. You don't regret paying for fire insurance just because your house didn't burn down. So, where does this leave us? What should you actually do with this information? First, understand that what's happening in the gold market right now is not normal. The combination of central bank buying, supply constraints, geopolitical tensions, and monetary system instability creates a setup that we haven't seen in decades. This is not a time to be complacent. Second, recognize that gold is not a trade. It's not something you buy today hoping to sell next week for a profit. It's a long-term position, a core holding, something you accumulate and hold through the volatility. Third, don't try to be too clever with timing. Yes, gold will have pullbacks. Yes, there will be better and worse entry points. But the risk of waiting for the perfect moment is that you never get positioned at all. The central banks aren't waiting. The smart money isn't waiting. They're accumulating consistently because they understand the big picture. Fourth, think about how gold fits into your overall financial picture. For most people, a 5 to 15% allocation makes sense, enough to provide meaningful protection if things go wrong, but not so much that you're making an all-or-nothing bet. And finally, understand that this is about more than just making money. It's about preserving your wealth and your purchasing power in a world where the rules of the game are changing. It's about having a foundation of real assets in a system built on promises and debt. The gold market is sending us a signal right now. Central banks are sending us a signal. The question is, are you paying attention? Because the time to prepare for a storm is before it hits, not after. And the signs of this particular storm are all around us if you know where to look. What happens next in gold is going to be fascinating to watch. But more importantly, it's going to be life-changing for the people who position themselves correctly. The choice is yours. You can ignore what's happening, dismiss it as gold bug hysteria, and hope that everything works out fine. Or you can take a clear-eyed look at the evidence, understand what the smart money is doing, and make sure you're protected regardless of what comes next. The gold holders who understand what's really happening, they're not worried about the day-to-day price movements. They're not stressed about pullbacks or corrections, because they know they're holding the one asset that has survived every monetary crisis in human history, And in a world that's becoming increasingly unstable, increasingly uncertain, that's worth more than any amount of yield or short-term gains.